听见资本本期视频为您带来的是摩根士丹利在3月20日英文闭门会的内容。先是美国的互惠关税政策，特朗普政府计划在4月2日推出一项针对多个贸易伙伴的关税新政，试图纠正贸易失衡。这不仅涉及产品关税差异，还包括增值税和不公平贸易行为，可能引发谈判，甚至部分关税提前实施，影响不容小觑。而聚焦亚洲经济体的处境，面对美国的要求，亚洲国家可能需要增加对美采购来缩小贸易顺差，还要应对提高国防开支的压力。尤其像越南、泰国这样的国家，贸易顺差占经济比重不小，调整起来挑战巨大，更别提与中国贸易关系的复杂性，可能牵动自由贸易协定的重新审视。再看中国经济，近期经济数据亮眼，政策转向起了积极作用，地方政府投资也恢复增长，但关税冲击下，第二季度增长可能放缓，政策会保持灵活应对，但大规模刺激暂时不在计划中，中期仍将缓慢再平衡。最后，关于投资策略的调整，在政策不确定性和增长放缓的背景下，市场轮动备受关注。他提到澳大利亚估值偏高，需谨慎，而台湾市场因半导体高估也有风险，防御性策略或许更稳妥。这场会议让我们看清了全球经济的脉动，也为未来的走势提供了宝贵线索。接下来是英文会议的全部内容。如果您需要英文原稿和我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Good morning and good afternoon, everyone. It is March 20th, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you're a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today we have Ariana Salvatore, U.S. Public Policy Strategist, Derek Kam, Asia Economist, Cai Zhipeng, China Economist, and last but not least, Daniel Blake, Asian EM Market Strategist and Head of APSG Quant Research. During this session, you can send us questions at any time from the Ask a Question text box. Firstly, let me pass it to Ariana to talk about the key views on reciprocity. Thank you.
Thanks so much, and thank you for having me. Yes, so I think that there's a lot of headlines out there and a lot of confusion around what exactly reciprocal tariffs, could look like. But just to kind of take a step back and talk about our framework here, we think that from a very high level, tariffs are almost certainly going to head higher, right, on a number of different trading partners. When the Trump administration sort of outlined its goals for this April 2nd date, this date of reciprocal tariffs, it really talked about, rectifying what it perceives to be trade imbalances across 3 different categories. So the first is product level tariff differentials. The second is VAT differentials. And the third is a more subjective kind of fungible unfair trade practices. So what effectively we're going to get on April 2nd, as per what's been telegraphed by the administration, is a number, right, for each country that should provide some clarity on the path, but probably not all of our questions are going to be answered by then. So we think what we could see is an initial starting point for negotiations. Maybe some select tariffs on particular sectors are going to go higher, but it might kick off a series of negotiations, as Secretary Lutnick has said, that on April 2nd, some tariffs will be implemented and other tariffs will be announced. So that means there could be potential runway. So that's kind of how we're thinking about this upcoming date. Really, there's little conviction in this path. There's a lot of different ways it could play out because the president has a lot of control here unilaterally. He could implement tariffs more quickly than we expect or more broad-based. He could kind of punt more into the future so we continue to have this series of rolling deadlines. But that sort of framework is guiding our thinking into this April 2nd date around reciprocity. Of course, that's not the end of the tariff story. There's other universal tariffs that Trump has talked about on things like autos, semiconductors, certain agricultural products. We also have the Mexico and Canada tariffs and the China tariffs. So this is just another piece of the puzzle, but that's what our expectation is for April 2nd. And I will stop there and see if there are any questions.
Thanks very much, Ariana. So maybe we'll address the questions to Ariana first because it's super late in New York. So I guess the first question is, which areas do you see the most at risk for the April 2nd escalation? And then what are the markets that you see will be the most likely to reach a trade agreement and then therefore can avoid further tariff escalation?
Yeah, it's a good question. I think the areas that we have relatively higher conviction in, one example would be something like EU autos. That's a sector that Trump himself has talked about specifically, even prior to the election. It's something where we see a tariff differential. We also see a VAT differential and some other kind of restrictions that we think the Trump administration could feasibly quantify as unfair trade practices. I would say something similar about EU agriculture. Now, conversely, where we think there could be some room for negotiation would be somewhere like India, or maybe, Japan or South Korea or Vietnam. And the reason is that in a lot of these countries, there's not already the existence of free trade agreements. So there's been an indication from both sides that they're willing to work towards some sort of agreement. We saw India and Trump, Modi and Trump recently said they were going to try to put together a deal by the end of this year, some sort of free trade agreement. There was a series of proposed increases that were backed off by India. So maybe there's some scope for negotiation with those countries. They haven't typically come into the equation when we've had tariff frictions in the past. So I think there's a lot of discovery that still has to be done. But that's kind of how we think about the relative balance of risks.
Right. And then is there any detail of how would the trade deal look like for those markets that you think that could potentially avoid a trade escalation?
Yeah, I think it's really challenging. And Chetan and team actually did a great piece of research on this, what could possibly come into scope. For some countries, it's easier than others because to the extent the trade deals are just reliant upon, increasing purchases, that could be, feasibly done. But at the end of the day, rectifying the trade imbalance will be definitely a difficult kind of bridge to gap. So I think that if the negotiations are centered around just ramping up purchases of certain products, then that should be easier. But again, the type of product is really what matters there. If they're agricultural products or commodities, that's something that politically speaking is more easy to accomplish. If it's something a little bit more high tech or specific to a sector where the U.S. has restrictions, for example, that could make it a little bit more challenging. And then you have this other element of defense spending, where the U.S. could be asking for these countries to increase defense spending. I don't think that's necessarily the story in Europe. I think it could be relevant for some countries in Southeast Asia, so that could be folded into the discussions as well.
Right. Thank you, Ariana. And then I guess we have the last question for you, and this is specific on the semiconductor tariffs. Do you think it could be levied on the embedded value of final products, or do you think it will be limited to the direct import of integrated circuits?
It's a little bit early to tell, I would say, because of the way the Trump administration has been talking about semiconductor imports. To us signals that there's a little bit more of the story still to come, right? They've talked about potential export controls as a response to DeepSeek. We're still waiting for that, for that kind of response to really take form. And when he talks about universal semi tariffs, we just haven't really seen much policy clarity to that end yet. So I think it's a little bit early to tell. We will definitely get more information on that front. But I think that it's a simultaneous effort between erecting these tariff barriers as well as non-tariff barriers and limiting the tech transfers in other ways simultaneously.
Gotcha. Then we will just keep it on the watch then. And I guess that's all of the questions we have for now. And then thank you so much for dialing at 11 p.m. in New York. Thank you so much. And then next, let me invite Derek here to talk about what does U.S. reciprocity mean for Asia specifically.
Yeah, thanks a lot, Crystal. So as Ariana sort of alluded to, right, as we sort of roll up to that April 2nd deadline, we're getting sort of more incoming details on what reciprocity could potentially look like. There's three things that you could have. One is that, as Ariana mentioned, there's a potential to sort of raise the purchases with the U.S. to sort of reduce that trade balance. That's not new. But two, we are sort of hearing two things that's sort of coming up, which is one, they're raising sort of potentially asking Asian economies to raise the defense spending as percentage of GDP. And second, based on what we've seen from the evolution of the U.S., Mexico, and Canada trade relations, we sort of explore also if there's a potential request for Asia ex-China economies to potentially place tariffs on China imports. So, on the first issue of sort of increasing the purchases to reduce the trade deficit with the US, one of the things is that, we have to sort of look at the headline level. For some of the economies, especially like those in Southeast Asia, like in particular Vietnam, or maybe like, for example, in Thailand, the size of the trade balance in the relative to the US, relative to their economies is pretty large. And it can sort of range from something like 9%, or in Vietnam's case, it's actually about 26% of the GDP. So that at the starting point just gives you a sense of the scale that needs to be sort of, in terms of the purchases, that needs to be increased, which therefore imply that, the challenges could be quite immense in that context, right? And especially sort of like, just to sort of belabor the point a little bit on Vietnam as well, currently it is importing about $15 billion worth of goods from the US. And so therefore to really bring down that trade balance effectively, you almost have to sort of see like a tenfold increase in imports at the margin. The second thing is also that, from a product perspective, right? So what kind of products can be imported? What kind of products may be sort of less rather maybe more difficult to sort of import from the US. I think the sort of like the issues or the goods that we've been talking about is, increased purchases of oil and gas, civilian aircraft, and also defense equipment, and to a certain extent, sort of like agricultural products, right? As you can imagine, some of these products will be easier for economies to sort of basically stick up the purchases. But for some economies where the transfer of sort of like defense equipment and also sort of like high-tech products where there could be sort of concerns from the US in terms of national security or technological transfers, which may therefore limit the scope of the purchases. On the second issue is really on the calls for sort of like to increase the defense spending. And this is really sort of like for the economies that have sort of been mentioned is really sort of like Korea, Japan, and also Taiwan. At the outset, I would note that, for Japan, Korea, and Taiwan, these economies already have plans underway to sort of increase the defense spending as a percentage of GDP. But, based on sort of what we're hearing from the US, in light of sort of the demands that they're having, these new targets may still sort of well fall short of the new demands that's coming up from the US administration. And I think also for each of the economies, there are also practical hurdles to sort of increase this defense spending meaningfully. For example, in the case of Japan, for example, Prime Minister Ishiba has already sort of pushed back on further increases by stating that Japan will decide the defense budget by itself and not be decided on the basis of what other nations tell it to do. Second issue is also that, as we know, demographic trends in Japan are deteriorating. Public debt levels are pretty high at the moment, and there was always going to be an increase in the social welfare spending burden, which would therefore constrain the ability to increase defense spending. On Korea and Taiwan, I think it's just really at this point in time, there are political developments that is actually sort of constraining the passage of laws which will enable further spending. And that will sort of probably remain in place for some time as we sort of move along through the rest of the year. The last things to know is sort of like, in the context of whether Asia ex-China economies could potentially sort of be asked to impose tariffs on China. Well, we think that actually it's going to be quite difficult, right? If you look across the region, economies are either A, dependent on China as a source of end demand for their exports, or B, they are actually reliant on China to supply them with parts and components to be able to sort of advance their manufacturing sectors, right? So that's at the outset. And the integration of China in the global value chain at about 41% in terms of the overall output, that just makes it much more complicated, especially for us in this part of the world, right? The other issue is also that there are also a number of free trade agreements that we have. There's RCEP, at the same time, ASEAN and Korea also have bilateral free trade agreements with China. And so therefore doing a sort of like imposing tariffs would therefore mean that these free trade agreements would have to sort of be looked at. And so therefore that's, I think if I were to sum up everything in totality based on what we know on the reciprocal tariffs or reciprocity in general, it does sort of hint to us that there are quite a number of challenges that Asia faces in order to sort of be able to take up meaningful steps to completely mitigate or avert the tariffs. That's it from my side. Back to you, Crystal.
Thank you so much, Derek. And then this is super detailed. And let me invite Zhipeng here to share the takeaways from the press conference and what does China policy function imply.
Yes, thanks, Crystal. So in the last week, two things happened in China. Number one is that the January and February hot economic data was released. And number two, of course, was the press conference on consumption stimulus, as you mentioned. So our bottom line for China is that growth remains stable for now, thanks to the policy pivot since last September, and some activities being front-loaded at the beginning of the year. But we do expect growth to moderate from the second quarter onwards with the tariff shock and policy easing will remain reactive to cushion the shock. Over the medium term, we still think low inflation is here to stay amid this very gradual economic rebalancing and very gradual social welfare reform. So first, January and February data, it came in very solid. If you factor in the fact that last year we had was a leap year, the year over year was even more respectable than the headline appears. So we need to recognize the impact of the policy pivot in last September, because prior to that pivot, there was basically policy inaction towards very disruptive deleveraging in the housing and local governments. That triggered the debate that this policy inaction renders China's assets being uninvestable. But the rising social stability risk eventually forced the government to pivot, providing proper support to manage the deleveraging cycle. We also had the biggest relaxation of home purchase restrictions in Tier 1 cities, and we have incremental shift towards consumption. So year to date, reflecting this central government support on deleveraging, we see that local government investment actually resumed healthy growth. Last year, particularly in the first half and the third quarter, growth was nearly zero. And then right now, it gradually recovers to around 8% growth in terms of the local government infrastructure investment. So that's echoing the policy impact for since last September. And then, of course, the strength behind January-February data was also stemming from some front-loading of activities, such as SOEs front-loading their production quota. The trading funds, the funds for consumption trading program was also allocated before the MPC, according to the press conference. And we also have some front-loading of exports still ongoing. So all these contributed to the January and February data. We think growth remains solid. First quarter GDP is probably tracking on par with the fourth quarter last year. So it's kind of a very respectable growth rates. But still, from the second quarter onwards, we expect growth to moderate amid the tariff impact. When I was in Singapore last week, we had some debate regarding, the actual impact on tariffs, because a lot of things have changed, since 2017 and 18. And the bulls will argue that the China supply chain have become much more versatile and much more capable to cushion this tariff shock after all these supply chain rewiring and after climbing up this value chain. But I think it is probably still a bit too much to say the impact was very little, because the tariffs are indeed coming in more sizable and earlier than we expected. But the sensitivity of the economy to tariffs could be smaller than the last rounds of tariff escalations. So we expect for every 10 percentage point rise in the average tariff rate on China's exports to the US, there's probably going to be a 0.3 percentage point direct drag on the GDP. So that's the key reason behind this, our call for the second quarter, for the call, the growth will moderate from the second quarter onwards. But another reason will be the policy will remain kind of reactive. We think Beijing will still evaluate the impact of the tariff on the economy before they make a move. Because as I mentioned, there's still a lot of uncertainty and a lot of debate on whether this tariff impact can be big or moderate or little on the economy. But having said that, the slowdown is probably not going to be an uncontrolled slowdown like the second and third quarter last year. Because this year, the fiscal policy, even though still reactive, it is still an expansion. So the MPC announced basically implied a 1 percentage point expansion in China's augmented fiscal deficit, which is probably the first time in the last 3 years. And then finally, on the medium-term outlook, we think reflation will be gradual. Recently, all of these green shoots, whether it's on the consumer space or it's on the housing sector, after seeing this, some investors are debating whether that will lead to more broad-based recovery ahead. And so basically, by the implication was that if that happens, maybe the equity rally, which is more tech-focused right now, will become more broader. Our view on this is still relatively cautious because, number one, we think the overall policy stance is still about providing a floor to growth instead of aggressive reflation using aggressive stimulus. And number two, if we look at China's progress in terms of economic rebalancing towards consumption from unproductive investment, we see that the support on consumption is still relatively modest. Monday's press conference or the overall guidance published on Sunday is still more about removing the bottlenecks for all kinds of consumption instead of real money spending. And so according to our estimate, whether it's this consumption trading program, 300 billion RMB, or about social welfare reform, which we estimate to be a 75 billion increment versus 2024. So all of these are very, very much modest. And then given the, the very robust first quarter growth, we think policy will remain relatively inactive in the coming months. And July Politburo meeting is probably going to be the next major policy catalyst. And if Beijing senses that there's a growth double dip, and that growth double dip can trigger, sort of stability risk, we do think Beijing can ramp up its current policy support. But what kind of policy support? I think number one, on consumption, they might expand these consumer trading program to more products or offering more heavier discounts. Number two, Beijing can roll out its fertility support program. It is still being studied according to the press conference on Monday. But if need be, they can start to introduce this fertility support program later this year, probably in the amount of 50 to 100 billion this year. And finally, Beijing might also front-load some of the investment projects of national significance in this 15th five-year plan, which is being formulated. So these are probably the incremental policy support that can come in the second half if growth really slows down more visibly, which might trigger Beijing to react a little bit more. But overall, we think, as I mentioned at the beginning, we think growth is stable for now. It will moderate from the second quarter, but not to the extent of a very disruptive slowdown. But a medium-term outlook, or whether this recovery can broaden meaningfully from here, our answer is probably not that certain. I would still think there are a lot of headwinds, and given the policy preference, we still think that maybe the first quarter or the fourth quarter last year is probably the height of this current growth uptick. Yeah, I'll stop here and hand it back to Fisher.
Thank you, Zhipao. And then lastly, let me invite Daniel here to talk about our defensive market rotation, where we downgraded Australia and further added underweight Taiwan.
Okay, thank you, Crystal. So a lot to cover. What I wanted to do is first pick up on this environment of policy uncertainty and growth slowdown in the US, which is dominating, I think, our recommendations for positioning here. We published a note looking at the impact of high policy uncertainty using one of the academic measures of policy uncertainty that's been developed. We are seeing that move up to the highest levels we've had in the last 25 years, with the exception of the initial COVID lockdowns. The trends on a 30-day moving average are still moving higher, and as we've heard, this April 2nd deadline for the America First trade policy reviews coming back, and also the implementation of reciprocal tariffs and potentially critical materials, including semiconductors, steel, aluminium, copper, and autos coming through. So policy uncertainty is going to remain high, and we think that as a factor is helping to drive the shifts that we're seeing amongst clients, a move towards degrossing portfolios. And what we've found, looking at the regimes of high policy uncertainty, if we take the top quintile of historical windows where we've got that elevated environment, what we've found is that the clear features in the market are a reversal of price momentum. We see the price momentum factor, which historically the last 25 years has delivered 2% annualized returns on APXJ. That turns into a minus 14% annualized return in periods of high policy uncertainty. Now that probably reflects some profit taking, also some degrossing that's driving that reversal of price momentum. And then on the value composite, what we find here is that what outperforms is low valuation equities relative to high valuation equities, when policy uncertainty is high. And the economic intuition is pretty clear in the sense that when we've got long duration cash flows sitting in some of the business models, and we lift policy uncertainty, we lift the discount rate, we find those high valuation, long duration equities underperform. And so we've found historically that the value factor, which is through the cycle given us 8% returns, long short, in high uncertain environments, that goes to 22%. And again, that's been very consistent with what we've seen coming through the market. So then turning to this question of US slowdown, our economists have cut their forecast for US GDP growth. They've brought forward the impact of tariffs. They've also seen the fiscal austerity through Doge at the margin weighing on the outlook for activity and the labour market. So they've brought forward that growth slowdown, and we are seeing Nasdaq partly reflecting the factor reversal and partly reflecting this growth uncertainty coming under some downward pressure. And so with US markets correcting, what we wanted to first ask was, how is Asia positioning overall? And our view is that we're actually not in bad position, partly because we have this deep valuation discount for Asia and EM that had opened up over the 2020s and really through the 2010s. We're showing the data here since 2018. If we look at EM versus US, we saw that discount move out to almost 50%. We've recovered some of that, and we've got further to go. And even if you take the Magnificent Seven stocks out of the market, we still see another 10% to go back to normal levels of discount for EM versus US ex Mag 7. So we have some valuation buffer, but we've also got a number of key markets that are moving in a more favourable direction here. And so when we're looking at the heavyweights within Asia Pacific, the good news is that we've seen some progress being made by China to improve profitability for the key index heavyweights, particularly in the tech sector, and product market successes from the EV and EV battery supply chain, as well as robotics companies, have also helped to underpin a view that China may be less dependent on semiconductor choke points that were seen in the past. And so the post-DeepSeek moment for China is a real inflection we've seen, and Laura Wang and our team have lifted valuation targets, particularly for the offshore China universe. Then if we look at Japan, so we like offshore China here. We still think there's further to go for positioning to increase from underweights that are still outstanding. If we look at Japan, Japan's on a much more solid footing for domestic reflation. To Derek's point earlier about Korea and Taiwan struggling to marshal the legislative support for funding defence, in Japan that's long been resolved under the Kishida administration to double defence spending as a share of GDP, and alongside the semiconductor localisation, the Economic Security Promotion Act, the domestic capex that's going into Japan, we see a number of opportunities on domestic industrials, construction companies, and defence exposures that can be quite resilient to a growth slowdown globally and to the tariff uncertainty. So we like Japan, particularly domestic Japan, or buying topics in unhedged dollar form to benefit from a resilient headline index and yen appreciation. Then finally, the other big heavyweight here is India. When we're looking at the mapping of exposures to the US, the overall universe we see here, we've got high valuation in Taiwan and Australia relative to the line of fit. India is also high valuation, but when we look at the exposure to the US in terms of the connections on revenues and index beta, India is one of the lower position markets here, alongside the emerging ASEAN universe. So beta sitting at 0.3. Revenue exposure under 10%, so we do need to watch that, but it's largely in services through the likes of the TCS and Infosys. So we like our more domestic recovery names in India as we're getting this fiscal and monetary easing coming into effect. So we think the index heavyweights in Asia EM one, have some valuation support, but also across the EM generally, but also have this domestic story, which is quite resilient, we think, to the tariff uncertainty. Where we're most cautious is on Taiwan and South Korea, but particularly Taiwan, given the relative valuations that are still sitting as elevated in the semiconductor sector. If we look at the Asia Pacific semis, it's still trading at 5 times price to sales. Subsequent 2-year returns have been pretty negative from those entry points in the past. And we do think we're at this inflection into the adoption phase of the AI cycle, as opposed to the upstream capex build out. So not looking for that to turn down just yet, but certainly the second derivative is slowing, and that tends to be the more important factor for semiconductor outperformance. So we're underweight on semis. On Taiwan overall, the valuations are still above their averages. This is on a price to earnings basis. But if you look at metrics like price to sales, Taiwan's still trading at the 92nd percentile of its 10-year history. So more positioning and valuation to unwind, we think, for Taiwan in particular. And the other key market we've introduced an underweight recommendation on is Australia. Australia also has that high beta and valuation correlation with the US. We've got multiples that are still sitting elevated to their long run history. We've got an upcoming catalyst of the Australian election. So when we've seen Australian elections in the past, the only experience we've had in recent years and recent decades of a minority government has been in the early 2010s. And we are looking at polling that's suggesting there's a reasonable chance of a minority government. So that may undercut one of the key growth engines for the Australian economy in recent years, which has been in public spending and around public-linked employment, which has driven 100% of the economic activity that we've seen over the last 12 months. So this factor for Australia is a downside risk. So we introduce an underweight recommendation, and for us, we prefer more defensive sectors in the Australian market, like telcos, real estate, and we do see valuation support in energy materials. But as Xupeng has laid out, we may not get the support from big reflation in China to get us momentum there. So these are the key calls we're making. The other key call that we introduced earlier in the year, so back in February, was an underweight on the Indonesia market. Clearly in focus here, given the valuation discount to history, given its exposure to relatively low beta to the US, relatively low revenue sensitivity to the US. So typically would be a domestic defensive growth market. But in this case, we are still worried about the lack of growth momentum, about some of the key reforms, and for us the key challenge is the earnings revisions are still not inflecting positively. So we do need to see, I think, more decisive efforts to stabilise investor expectations and confidence about where the trajectory is going for Indonesia's profitability. So I'll stop there and hand back to you, Crystal.
Thank you very much, Daniel. And then now we'll move across to the Q&A session. And you can submit your questions by using the Ask a Question text box. So the first one is for Derek. This is in particular about India. And then how do you see the prospects of a deal? And then how do you expect the timeline to be?
Yeah, thanks a lot, Crystal. I think as it comes to a deal, there are two sort of aspects that comes to India. One is that sort of there are very, very high tariff rates on select products. And then second is also sort of like the purchases that, India could actually make to sort of reduce the size of the goods trade surplus with the US, right? So on the first issue, I think there's already been sort of moves that have been made by the administration in India. Tariff rates were sort of cut for things like motorcycles from 50 to 30% in the recent budget. And there are talks and sort of like reports, or rather that the Commerce Minister is actually in DC to sort of offer sort of more sort of potential more concessions on that front to the US administration. I would also know that President Trump also sort of mentioned quite positive things about that going on that front last Friday when he was in the Oval Office, right? So that's on number one. Number two, on the purchases part of it, again, sort of India has sort of committed to sort of purchase more, oil and gas, defense equipment, also civilian aircraft. And our analyst, Mayank, has basically sort of said that, there is actually increased capacity in the US LNG space that can actually meet this demand, not just from India, but also from other other Asian economies as well. The challenge, I think, is just really one of timing. As we know, April 2nd is sort of rolling up. They have also said that, the first tranche of that trade agreement will probably be completed by the fall. So I do think that, in terms of timing, it may be the case that, you can potentially sort of get tariffs going up before sort of getting negotiated down as we sort of work through that deal. Back to you, Crystal.
Thank you very much, Derek. And then the next one is more on China. So in terms of the future policy direction, do you think it will still focus on the supply chain? And then what is the optimal combination of supply side stimulus versus consumption stimulus in your view, Zhipeng?
Thanks, Crystal. I think the overall picture is that it will remain pretty much supply-centric, but at the same time, there will be very gradual rebalancing efforts. So the reason is twofold. Number one, of course, the supply-centric mindset is very sticky, but I think we can all agree that since last September, policymakers also showed some pragmatism. So given some of the external constraints in export markets, given that the deflationary pressures, I think government is indeed, focusing more on consumption relatively to 1 year ago, with all these, consumption trading program as well as the potential facility support. But nevertheless, if you look at, the incremental funding versus between tech versus all these consumption and social welfare, we can still agree that, the latter is probably a fraction of the former. So overall picture is that, yes, it's very much supply-centric, but we are seeing some incremental rebalancing. Reason number two is, of course, there are also some administrative barriers in terms of the relation between local governments and the central-local relationship. On Monday, I think one of the headlines that was on Zhejiang province, which decides to provide public education access to all the migrant workers' children. The reason why it was a headline is because in the past, it usually is very hard for the children of migrant workers to get relatively cheap public education in their workplace. They have all kinds of administrative barriers. So the reason then Zhejiang province, decide that we are going to provide these education access to migrant workers. But why this implementation will be very difficult? Because it inevitably requires intergovernmental transfers. Because to provide the education in province A from province B probably need to transfer some funds to province A, but that is very difficult, and it also needs central government coordination. And sometimes province A, the one who provides the education, also needs to get can ask for more central government direct transfers. So all these kinds of negotiation and incentives also made it quite kind of difficult to really improve China's social welfare system at a very fast pace. So realistically speaking, the pace of welfare reform is also going to be relatively gradual. So combining these two reasons, the overall direction of travel is incremental, more rebalancing efforts, but overall relatively still supply centered. Yeah.
Thank you, Zhipeng. And then lastly, there is a question on Japan and China as well for Daniel. How do you quantify the impact from potentially stronger yen? This is for Japan. And then what is keeping you from turning more positive on China in your market allocation?
Yeah, no, great question. So for Japan, we do see an overall impact for every 1% move in dollar yen, about a 0.5% impact in terms of both the equity market sensitivity, if we look at the correlations, or if we look at the earnings sensitivity, if we build this bottom up on the basis of pro forma FX impact on operating profit, it also rolls up to around 0.5%. So that's typically the beta we have for a stronger yen. Now our forecasts are for some strengthening in the yen, dollar yen. We've got that landing the year at about 141 at year end, but we do think there is some resilience built in. So firstly, we are seeing consensus guidance by companies, and we're seeing analysts assuming numbers closer to 147. So there is a bit of buffer here for some further appreciation. Beyond that, we do think that this will be an incremental headwind. The consensus is looking for around 9 to 10% EPS growth. Now, we think that's largely deliverable because we are seeing upside surprises in the recent earnings updates. We're seeing some conservatism built in, and it's really around domestic Japan that is benefiting from this high price and wage feedback loop that's helping to deliver that. So we think within the market, our position away from some of the high FX sensitive names towards more domestics. But for Japan overall, we think it can deliver that high single digit EPS growth in the context of this resilient domestic profile that ultimately at these valuations gives us more upside for topics. I think that the clearest way to express that would be through unhedged investments, so benefiting from that yen appreciation and positioning for domestic names. And then the question on China is really a function of that question of whether this will broaden out further. And so for us, our aggregate equal weight position on China reflects a combination of domestic deflation concerns with strong performance we're seeing in some of the key industry technology leaders. And so that balance gives us an equal weight. If we see this broaden out and we start to see animal spirits picking up amongst the consumer, those high savings rates turn into demand, then we can be a bit more confident to lift China in aggregate. And on the flip side, we also need to watch for this uncertainty coming out of April 2nd. And so while the market has traded up through the tariff increases we've seen on China so far, has really looked through the 20% delta on tariffs into the US. There is still uncertainty about further non-tariff barrier restrictions that needs to be assessed, including the America First investment memo, which does raise questions around the treatment of the VIE structure, the treatment of the ADR agreement on PCAOB oversight. So there's still a bit to work through in terms of that uncertainty in April. But within the market, we can find names that we want to be overweight. So we can build a portfolio that looks overweight, but in aggregate, we would rather be a neutral balance here at this point.
Thank you, Daniel. And then I guess those are all the questions we have for today. And then we will conclude the webcast here. If you find this session useful and you want to join our other series, or go to the Asia Research landing page on the portal for collection of the region's most important research and our audio video series. Thank you for joining, and do reach out to me and the team if you have any other questions. Have a nice day.